Yeah, the profitable section is actually Starlink. So
That's
Starlink is
right,
a
dude.
profitable business. It's doing really well. It's doing great. Everything else is currently we're losing money. We're not bringing in enough profit, enough revenue relative to what our spend is. So we're negative cash flow. So it's hard to value a business when a business doesn't earn a profit. What's up, man?
Scott, what is going on?
A lot of excitement in the markets these days.
I haven't heard anything. Fill me in. I've been living under a rock.
Well, we try to train our clients to
You
be
sure do.
uh, to not pay attention to the craziness of markets, but sometimes the fervor gets you, and it's exciting. And so I've had a few people reach out about the SpaceX IPO. You?
Mm, as have I. The email has been active, the phones have been ringing, and it's exciting. There's a lot there, and I think we should probably dive into it because on the surface, it's teeming with excitement, it's buzzing. There's a story there. Everyone wants to be a part of it, but sometimes the numbers, oftentimes, tell a very different story, and it's helpful just to peel back some of the layers, understand what we're getting ourselves into before making a really important decision.
Yeah. So one of my clients who's an executive at a Fortune 500 company reached out and was like, "Hey, essentially, like, what do you think of this article, which was about how to get access
Hmm.
to the IPO for retail investors, and essentially, like, I want to buy some. How many can I buy, right?"
Yeah.
Um, and that in a sense is the right question to ask, but kind of in the wrong order. So I think our goal today is going to be by the end of this chat for you all to have a question or two that cuts through the noise of any exciting IPO, not just SpaceX.
Yeah, I mean, because this summer is going to be hot. Whether it's at the end of this summer, SpaceX, where I'm getting at, is not going to be the only one. It's getting all the news and attention because I believe it IPOs on the 12th. If we're listening to this now, we're recording it on the 5th, so I think it's literally 1 week from now. It's next Friday. But there's other ones in the pipeline, Anthropic, and a couple other ones that are set at some point to follow suit. So SpaceX is kind of just hitting the table and being the first one there.
Yeah, and like for look, we work with very bright people.
Hmm.
Like the kind of the instinct, like you kind of maybe understand the technology, or you're like, wow, what they're doing with Starlink is amazing. There's a lot of other, they're building out AI. They're, trying to colonize Mars. This is SpaceX specifically, but everyone's going to have their own story as they lead to an IPO. And you've kind of seen some moonshots pay off in the past. I kind of think about Amazon and how Amazon IPO'd largely before a lot of what they make money off of didn't exist at the
Hmm.
time, right? And maybe you have a little bit of money in your pocket to go put some money to work. Um,
Sometimes for me, I think of, with Tesla reinventing the EV market, and
mhm,
how ahead of its time it was,
sure.
uh, and its CEO, um, very polarizing individual, right? He's in the news all the time, and he's done a great job with all of his different visions. And so I think a lot of times there's a lot of excitement with what he's been able to do with Tesla and Starlink and all of this. Is this the next frontier? And I want a piece of that because I think it's going to be, the next thing, right?
Exactly. And I think that you got the right frame there for that, for sure. And then I think that the kind of the next um thing to think about though is, yes, you understand the technology and the technology is real. That's great. Whenever an IPO is happening, you want to look at the fundamental valuation for how are they pricing this to see, is this a good deal? So if we just think of it really simplistically, um, maybe you're like, my favorite uh truck now is the Ford Raptor. I have one. I love it. It's
I,
awesome.
you have pivoted hard from a Prius
From a
days.
Prius, I pivoted super hard.
Wow.
But here's the deal. Would I love the Raptor if it traded at $300,000 versus $70,000? there'd probably be a big difference in how much I value that,
Yeah.
right? So it's not just what's the moonshot, what's happening here. It's understanding what is the underlying revenue model that they are pricing this at, and that's one of the things we're going to look at today.
Yeah, and you said a lot. You said a lot there, right? You definitely had the CFA hat on, and I this is so important. I think for people to really unpack because a lot of times I think whether it's with SpaceX or it's any company, we're buying a story of tomorrow. What are the future expectations? What is it going to deliver? And to your point, when it comes to post IPO, once it goes public, figuring out what is it going to trade at, but that stock price represents really it's fundamentals, as you said, and understanding. We could even give a little backstory on pre-IPO, who the investors are, what that timeline looks like, and who's cashing out, and how the mechanics of how that works. But once it finally gets to you, the shareholder, once it becomes public, what you pay for it really matters, and it's runway of are you going to make money on this thing?
Mhm. Exactly. Um, and so where we go with that is like, let's just talk big picture about like what even is just an IPO, right?
Mhm.
So why does it happen? So, like the textbook answer that I learned in like CFA world back in the day, it's a way for a company to raise capital for growth.
Yep, pretty simple. Yeah, they need
It's
money.
it's
Where are they going to get it?
so they take it from being a privately held company to a public held company, and when that happens, they have an initial public offering. That's what IPO stands for. And they go out and they raise money. Investment banks are hired to raise money. So investment banks make money off of the sale going through at a positive outcome for the company. Now, they can structure it in many different ways that I'm not going to get into here because that's way too complicated, but that's essentially what happens. So that's the textbook answer. Now, what's the real answer? The real answer is IPOs give insiders, so whether it's the venture capital firms that funded the company, or employees or founders, a way to cash out. So it's not to say that it can't be for raising money, it can raise money, but it can also be a way for people who are already entrenched to get money off the table.
Right. And I look at this in two different camps, right? We either have the early stage funders, VC firms, there's your capital, or we also look at early employees who have been with this company since day one or very early on, who are rewarded. And we've done a number of episodes on equity compensation. But to your point, regardless of what party, it's a liquidity event. And when those people, those parties and institutions are selling those shares and bringing it to market, they're cashing out, right?
Mm-hmm.
And that is where, and we've used things like um, have had clients, right intention saying, "Hey, how do we get pre-IPO exposure to this?" Which is very difficult because that's where a lot of the money is made. And then once it goes to market, anything could happen because it becomes available to the public. Everybody else is cashed out, so on and so forth.
Exactly. So, like, one of the things to recognize so the way, and we'll talk more about how traditionally IPOs work
Yeah, it's
as
changed
well.
for sure. Yeah.
But one of the things to realize is if they're allowing retail investors, normally an IPO happens to institutional investors where they go around in a roadshow, and they basically, all the investment banks go around to all the big fund managers and all the big pension firms, all those places, and they say, hey, we'll give you guys shares ahead of time. And I'm going to jump ahead a little bit. They traditionally give it at a price that they think is going to be below at what it will trade on the first day, so that when it trades, it pops. So all of those institutional guys who committed to buying can go sell to the open market to the retail investor and make money. It's the mechanics of how it's designed. In this instance, they're trying to get 30% participation by retail investors. That is not normal. And that leads me to pause because
Mm.
it makes
And
me go, hold on,
might
what's
bring you,
going on?
hold up. There's a why there. What's going on, right?
Yeah, we'll look at it. We'll look at it.
Yeah.
But so I think where we go from there is like that's why they typically do this, right? So now SpaceX must signal publicly that they don't need money, but the numbers say otherwise. They
Well,
run
hold
about
on. Can I ask you? So, one thing I think we've learned through this process, and some of our listeners may have read this as well, is when something goes from private to public, something happens. The books all of a sudden are opened up,
right.
right? Right? Because when you're a private company, you can do whatever you want,
Right.
right? You're not obligated to really disclose to the public the same way public companies are under scrutiny. And so when they go through this process, to your point, just wanted to set the context here, we found some things that would tell otherwise.
Yeah. So like they have to disclose how they're what they're actually doing, what their free cash flow is doing. Free cash flow basically means money comes in, money comes out, with some basically looking at to remove some manipulation that occurs on a balance sheet. Because just to be super geeky for a second, we run a cash what you would think of as like just uh, a cash basis system for like at home. We have a checkbook. We don't actually have checkbooks anymore, but on your statement of banking, you either get money in or money goes out. In a business, they can use this thing called accrual accounting to make it so that money shifts over time for different reasons that exist that keep CPAs employed, and that's great. They make sense. But when you look at that, they lost about $12.8 billion in free cash flow in 2025. So they burned $30 billion in 4 quarters. And the chat AI, the XAI section alone spent $7.7 billion in Q1 of 2026 with an operating loss of $2.5 billion.
'Cause there's a
So
lot of things here, right? Because I
yeah,
think when we look
big
at
numbers.
SpaceX, we also have to remember it's not just SpaceX, right? We're not just going to Mars and building data centers or whatever their mission's going to be, but we have xAI, right? And they also had Twitter, right? And they all rolled into one. We still have Tesla as a standalone, but there's a strategy there, and so it looks like we have multiple companies that all have different balance sheets built into one, and this liquidity event is funding a lot of the cash that XAI company is burning. This is what we're beginning to find out when we understand or unpack what the share price reflects, what we're purchasing it at. There's a fuller story.
Yeah, the profitable section is actually Starlink. So
That's
Starlink is
great
a
news.
profitable business. It's doing really well. It's doing great. Everything else is currently we're losing money. We're not bringing in enough profit, enough revenue relative to what our spend is. So we're negative cash flow. So it's hard to value a business when a business doesn't earn a profit, right? If you do that for long enough, you eventually go out of business.
Mhm.
You eventually have to show profit. Now, that neither here nor there. But to you kind of with that with all of that underlying, they're looking to raise um raising about 25 billion at that burn rate would be about a year of runway for them. Or said another way, if they raise 75 billion, which is what they're trying to do, it's about 3. So, you know, you're basically if you're putting money in, you're putting money in not to not to reward yourself with profits from a business, but to fund the expansion of a business that does not yet show its way to profitability.
And I think something that you just said there, where it's like it's not yet profitable, that's what we're purchasing, right? Is a story of tomorrow,
Yeah.
right? And there's metrics that we use, but that's we have to understand what we're buying, right?
Uh-huh.
Because when a company doesn't have the profit to justify, there's certain ways the stock price works. We can certainly have the pop on hype and hysteria, and we've certainly seen the mania many times, 2020 being a classic example. But I feel like when the tide runs out and we don't have the revenue, those sales to justify it, all of a sudden it gets really ugly really quick. And so I think what would be helpful too, Scott, is just how does this stack up against other companies that we know and love, right? Just to put it in comparison, because these numbers sometimes they're just numbers and they can be really arbitrary or really big and
Yep.
hard to compare. So when we
Yep.
think of like Apple or Amazon or some of these big ones,
Yep.
what does this look like?
Yeah, let's go there. But before we go there, we're talking big numbers, which are hard to understand in context.
Yeah.
So if you think about we're talking about a billion like it's nothing. But if you take a billion seconds, that's 31.7 years ago.
Okay. I'm
If
with
you
you.
take a trillion seconds, that's 31,700 years ago. So put another
1/106.
way,
Huge
a
amount.
billion seconds ago was 1993. a trillion seconds ago, humans hadn't invented writing yet. So those are huge numbers, right? Just to put in context, because like you sometimes hear a billion and a trillion, and you don't realize how big of a difference
Huh.
that is.
One letter apart. Right.
Yeah. But the point is that the valuation um, that they're giving SpaceX is $1.77 trillion based on $18.7 billion of revenue. So that is about 94 times revenue. Now, to be super geeky and wonky, normally when we're doing an IPO, we're looking at things like what's the price to earnings ratio? What's the other ratios? But we don't have positive earnings, so we can't do that.
I think that's important to understand. Like earnings, we should understand, like, why can't we use price to earnings? Well, they're not
Because we had a
profitable.
$5 billion net loss on what they reported,
And so
right?
if that's not a red flag, right, we have to use other metrics, right? And to this point, price of sales, or in this case, revenue, right? Same thing. Um,
Yeah, but let's just give the context of revenue like that way.
yeah.
That's a 94 times revenue. You're like, well, what is that? Tell me what that compares to. Okay, so Nvidia, which was trading a little crazily at its peak, was trading at 25 times revenue and was profitable with 55% margins, right? Amazon, that also bet on business that didn't exist yet with like AWS and Prime Logistics, trades at roughly 3 to 4 times revenue today. And then like one that I did it because we were just chatting about it. I just quickly looked up, well, how much did Tesla trade at its peak when it was the most hyped car company in history? And at its peak, it traded at 25 times revenue. Said another way, like 4 times less than this valuation.
Yeah, I know I keep coming back to it, but this when we start talking numbers like this and valuation, because it's nice, right? When we look at revenue, we have a concrete, tangible, physical metric to say like this is what it trades on.
Yeah.
We're buying. I keep saying it, but we're buying the story of tomorrow. That you are betting, right? When your share price is at that level, so many things have to go right in the future for you to break even because you're buying it way up here, right?
Right.
Some of these massive businesses, to your point, I looked up Apple, they're at like 9.5 times revenue. Amazon's at 3 or 4. That's unbelievable. And so to put it in context, that's I think oftentimes something that gets missed because we get so fixated on the story of what it could turn into.
Right. Now there's a professor from NYU who's kind of called the dean of valuation, and he built a full model and ran Monte Carlo, and he thought that its fair value was somewhere around 1.2 trillion. Um, but he actually, after he got all the releases out, thought it was more like 1 trillion. But all of his base case is based on them growing at 40% for the next decade in a space that's never been done before. Like no companies, I think the stat was in the article, no company has grown at 40% year over year over year for a decade.
Well, we see it in our businesses. We talk about this all the time. How when you're a little itty bitty company, how easy it is to have those bigger, multiples or that growth margin,
Yeah.
and then you get bigger, right? Same works the same way in small to mid to large. Competition comes in, that moat comes down, and to grow at that scale as you get larger and larger, it's nearly impossible.
Mhm. Now, let's just say that like you're yeah, so like this is all pointing toward like this sounds like it could be overvalued, right?
Potentially,
Like when I just look, if I go apply the logic of the two highest revenue revenue multiples that I've seen on the conversations we've just been having
right?
are Nvidia and Tesla at 25 times. If I apply that, that's about a $470 billion valuation, or that's saying that this is overpriced by about 73%.
Well, let me ask you this. I want to segue because I think this is related. This is obviously not the first time a company's IPO'd, right? I feel like there, and we can certainly look up, there's been times that either investment banks or hype or a combination has gotten the IPO wrong.
Oh
And
yeah.
when we begin to look at because it's just a shot in the dark. It's doing our best job,
Pets.com, baby.
right?
You just have to go back to the end of the tech boom when people were releasing companies on the promise that it would figure out how it was gonna do it in the future.
Just put a .com behind it and we're good,
And
right?
how that turned out for a lot of people was very poorly. You
Yeah, I
have to be
mean, we
willing
go.
to accept a lot of pain if you're gonna invest at these types of valuations.
Mhm, mhm. DFA, a fund company that we know and love. We talk all the time about. And we use at our own firms. They ran a really interesting study, 6,000 different companies that they surveyed and got the data on dating back to 1991. They found consistent underperformance across IPOs. Right, that as soon as an IPO did underperform by about 20% over the first 3 years from day one. That's
Yeah,
pretty
now
bad.
that actually builds into the mechanics of how traditional IPOs work, which I was referencing a little earlier.
Yeah.
So the way it traditionally works is retail investors don't get the IPO price. They have to buy the day of the IPO in the open market.
They're
So
last in line, right?
they're last in line. So you're not you're hold in a sense you're holding the bag, right?
Mm,
If you want to get in on the first day, you got to end up holding the bag at the higher price. Because the way it works is they go like, we're going to release, X number of shares, and they go around and they sell big blocks of it to all these big institutional investors. Maybe some individuals within those institutional investor companies get some shares. Definitely their funds do. And then what happens is when they release and it pops, they go and they can sell it. So a really simple example would be DoorDash's IPO. You know, basically underwriters deliberately underprice to generate buzz, and then institutions buy at the IPO price. Retailers buy after the pop. So DoorDash opened at $182 on IPO day against $102 IPO price. So any institution that sold those shares to retail investors that day made 78% overnight. But then what happens is there's a lockup period for the employees of the company. So for a lockup period of either 90 days or 180 days, they're not allowed to go sell the majority of their shares. They have to wait. And once they can that kind of like timeline is lifted, they flood the market with shares, and that brings down price because it's supply and demand, right? If there's only 100 shares available and there's a lot of demand, it's going to drive up price. But now if there's 10,000 shares available and there's not as much demand, it's going to drive price down. That's just the way markets work. And so for that, you end up seeing this data with DFA that IPOs on average underperform the market by 20% over 3 years from the first day close. That's not saying the IPO price, that's saying the first day close, right? Now, traditionally, retail investors aren't allowed to participate. The thing that has me worried about this is they want 30% participation of investors. To me, that means they want people like the executive that reached out to me to go like, SpaceX is a moonshot. I want in. I want to participate. It's going to do great. They're not paying attention to the fact that it's trading at 94 times revenue, pardon me, can't trade on earnings because we don't have positive earnings yet. When nothing, I don't know if anything's ever traded at revenue that high. That's actually the question I'll ask after the fact.
well, and this is I call this the hype tax, right? It's the premium we're paying for the story that's at peak excitement right now.
Yeah.
And when
And
we
that's
work
the,
when we work with clients at other companies who go public, our frame, Scott, is this is an exciting event for them because it's a liquidity event.
yep.
But you're now as an investor, right, not employee, buying it post liquidity. This is an opportunity. To your point, it's a moonshot. And so we always have to say, like, whose lens are we looking at this through?
Well, and that's really the gut check, right? The gut check is understand what valuations you traditionally see in these spaces. Now, this is a space where there's not a lot of valuations. So maybe we have to go. So what we basically did was we went and looked at what are the major growth companies that were hyped. What were they trading at for some relative understanding, right? And to be clear, we're not sitting down as analysts and going poring over this for a week at a time and going through every line. We're just looking at it from a smell test standpoint, essentially. But if you strip away no Musk, no rockets, no Mars, and you get a company with 19 billion of revenue with a $5 billion loss and a $30 billion cash burn with no voting rights for public shareholders and a 94-time revenue multiple, would you buy it on those terms alone?
Wow. When you put it that way, I mean, it's like it's every dollar of valuation, right? Above what the business, to your point, is actually worth. When you strip everything away, that future performance, literally every domino has to fall right just to break even.
Yes. And so
Because that's
that's
what
to
when
me
we start
the
looking at
main thing is like
revenue in the future.
recognize that if you still want in on this thing, this is not an investment. This is a lottery ticket.
It's well said. Yeah.
Lottery tickets usually are only worth how you feel until the numbers are read. What will I do with the money? How will it change my life? Because you normally don't get the win. And more than likely this won't get the win. That's my interpretation, right? Based on the way that it's structured right now.
So let me ask then, because hold the bag, home run plays, moonshots, they could belong in a portfolio. So for our listeners, where does this fit in?
Yeah, I mean moonshots can belong in the portfolio. Well, one thing is, guess who invested 15 has a I think it's a 15% stake in SpaceX? Do you know?
I don't know.
They're one of the largest companies in the world.
Is it? Oh,
They have 26 letters that kids like to sing all the time.
how is it Alphabet?
Alphabet.
Okay.
So own Alphabet and you'll be along for the ride, right? But you'll be along for the ride in a more diversified manner. That's one way that you could do it. Another way that you could do it is you could own um, index funds. Now, I'm actually kind of upset with some index funds because they're
Yeah.
breaking their own rules on how they're going to create an index, how they're going to let funds, SpaceX in to basically accommodate for the purchase. But it's like inside baseball. But investment banks are going to make about $500 million on this transaction. Investment banks on the other side of the wall happen to own index funds.
Hmm.
Interesting. Not cool. Because like so the S&P 500 did stand up to this. The S&P
That's
500
pretty
for
cool.
you guys at home know it's the 500 largest companies in the US that are profitable.
Well, here's the thing. You may not know this. Index, the S&P 500, it changes all the time. So those 500 companies, 503, 504 last time we checked, they're constantly rotating based off of what you're about to get at, Scott, which is, hey, there's certain criteria, and if you can't withhold it, you're out.
Right. So it's just I think that'll be another way that you will be able to own the stock in the future.
Right.
But basically, what have we shown today? The valuation, I literally sent the emojis bat, poop emoji, and then said crazy to my executive because I'm like, this is bananas that people are actually walking around saying that this is real. This is the kind of stuff that makes me think we're near a top when
Yeah,
if this
because when
goes
you
off without
started
a hitch.
talking about emoji, my mind just went to not the poop emoji, but the rocket ship one, which is oftentimes a sign at the top.
Yeah, but I think end of the day, it's like, you have to look and see what you want to do. Every dollar that you invest in SpaceX is a dollar not invested in things that are considered profitable. Um, and, the question isn't whether SpaceX will go up, it's will SpaceX outperform your portfolio, right?
Absolutely.
And we're of course we want to think that it's going to be a moonshot because it's literally like a Mars shot,
Right.
right? Like of course we want it to win. I want it to win for humanity. But at these valuations, I don't want my clients investing in it.
Well, and you hit such a key point there. Like our jobs, right? As investors, for us as advisors, providing investment advice is to do everything in our power to tilt the odds of success for our clients in their favor as much as possible. And when
Yes.
we start to unpack this, we're like, man, there's a lot of chips stacked here saying a lot of things and then some based off of how it's priced have to go right. So that's all we're saying.
Absolutely. And if you're going to do it knowing don't bet the farm on it for sure. and do it knowing that like pain may be to come and you're probably going to need to hold this for a very long time to see any valuation close to what it's currently at.
Absolutely.
And
Abs
there could, it could become the next Reddit stock for all I know, right? And it could be like a GameStop and everyone races it up as well. But fundamentals at the end of the day over the long term matter. Like you have to have a valuable business that can actually sustain itself in the long run. In the short run, craziness can always happen.
Right, and we don't need to pay attention to fundamentals in the short run. We've seen that time and time again, as you alluded to with GameStop, but
Well, that happened with all the pets.com stuff as well.
absolutely.
And
Yeah.
then from that, just to point out, like Amazon started during that period of time, right? It was one of I kind of say a few because relative to the amount of companies that IPO'd back then, it did survive and it became this giant, right? With this really long vision and did really smart things, but it still trades at 2 to 4 times revenue,
Yeah.
not 94.
Yeah.
All right, I think we've kind of beat that one to death. Um, but I think the key takeaways are this: examine whether an IPO is a strength IPO or a funding IPO. I would call this one a funding IPO, even though Musk says it's not. Um, think through what the valuations require for it to be true, not whether the company is great, but whether the price reflects a future that has already happened or one that hasn't. This one is totally predicated on something that hasn't happened yet. That's just where we are. And consider the story. Consider what that story's doing to your judgment. That's where that gut check that we said of like strip away the story, look at the underlying numbers. Would you invest in this company?
Well, and here's the thing too, like, we may very well eat our words, and I'm all for taking our medicine. And it may be an exceptional company down the road one day and continue to innovate, right? Um, but when we look at stock market history, there's a big difference between exceptional companies and exceptional investments, and that's all we're trying to point out, right?
Yes.
And oftentimes, right, fundamental 101: sell high, buy low, right?
Yeah, no,
Oftentimes, it
and to
comes
be
down
clear,
to
like I'm rooting for
absolutely
SpaceX and what they're doing.
right.
Like the fact that they created reusable rockets to basically bring down the cost of taking things up to space. That the vision that Elon has to get us there is all amazing. The price that they're doing this at has makes me feel like they're in a sense pulling one over on the public.
Yeah.
To go and to try to raise money at this valuation is just crazy. Like it feels it to me it feels like it's borderline um unethical.
Hmm. Hmm.
Personally, I would not feel okay raising money at this valuation. I would feel like I'm the mom and dad who like work, the 9 to 5 job and have the blue collar job and are going to go try to buy a share on Robinhood. I hope I'm wrong, but it just feels like it's not good for them.
Yeah, you and I share the same sentiment. I think when we start talking about indexes loosening, their requirements for the index to go buy shares of this because it has to hold it and all that's required, even though the company is not profitable, that's where I start to get upset because the 401ks of hardworking Americans now have to own that as opposed to someone with their own will and volition going out and buying it by themselves on
Right.
Robinhood. When you're forced to buy it in the index, that's where we as financial advisors, you want to ruffle our feathers, right? That's where we're
And those
coming
those rules were created
for a
to
reason.
help protect the
Yes.
average investor.
Yes.
Yeah. All right.
All right.
Enough of that. Until next time, sir.
All right, Scott.